Hello. In our continuing series on the functioning of notes and mortgages within the mortgage industry, today I have my longtime partner, Brian Nettleingham. Brian, tell the audience a little bit about yourself.
I've been at Maddin Hauser for over 20 years in the financial services group. I've handled a wide range of matters relating to the mortgage industry, from regulatory work to secondary market transactions to licensure to litigation over buybacks and repurchases. I've also handled an extraordinary number of vendor matters where we help our clients engage vendors in a way that meets all of their regulatory compliance requirements.
Well, thank you, Brian. And so, as part of our series on the note and mortgage, we've had discussions on the function of the note, the function of the mortgage, the various role players under those documents: borrower, mortgagor, mortgagee, lender. We've brought in MERS as well. Today, you're going to talk to us, however, a bit more about the functioning of the mortgage document itself and how certain provisions ensure that if we have to foreclose, that we as mortgagee will be first in line to get paid. So, talk to us a little bit about how does the mortgage document help protect the mortgagee's interest in the property as to third parties?
So think of the mortgage as, in itself, protection for the lender. The lender gives the borrower money to purchase a home. They take a security interest in that real property, meaning if the borrower fails to pay, the lender can then take the home, sell it, and repay the debt. That's called foreclosure. The mortgage itself is a recorded instrument, meaning it's executed, it's signed at the closing, and then the lender takes it and records it with a register of deeds, typically at a county level in the state where the property is located. When that happens, we consider that mortgage to be perfected. If the mortgage is never recorded and made a public record, then others can't know about the lender's interest. So the very first step in making sure that the lender's interest is protected is recording that mortgage. We call that perfection. And that's what the role of the mortgage is. Put the world on notice that this property is already offered as security for a loan so that no one else can claim priority over that bank's interest in the property.
So typically one hears about, as you just noted, that when a mortgage is granted, it has first lien priority on a particular property. However, is it possible for other interests out there in the world to gain priority over that first lien priority mortgage?
Yes, it is. And we'll talk, I think, a little bit more about this as we go on, but there are interests, financial interests, that can attach to a particular property and can, we'll say, trump or jump ahead of our lender's lien. Examples include certain tax liens and HOA or COA, which is homeowner association and condo owner association liens, are particularly notorious in certain states for having super priority lien status, so that when they're recorded, even after that mortgage is perfected, they can take priority over it. And so the mortgage will contain certain clauses and additional protections, measures that the lender can take to guard against those circumstances.
Okay, so let's break that down a little bit. So those super priority liens, and I know there are also, you mentioned tax liens, HOA, COA liens. There are also sometimes blight liens that can take priority, and other statutory liens around the country. But these super priority liens that can arise, what are some provisions of the mortgage intended to protect against that from happening?
Well, the mortgage will, first of all, have an affirmative statement or obligation by the borrower that they will not allow other liens to take priority. That's not always up to the borrower, so there are additional protections that the mortgage gives to the lender. That includes escrow provisions, whereby the lender sets aside money from every payment to make sure that taxes are paid and other amounts are paid to prevent some of these liens from taking priority over the mortgage. A due on sale clause, which prevents the borrower from transferring title of the property to someone else and trying to disrupt the lender's interest in the property that way, and insurance to make sure that the insurance is paid in order to protect the lender's interest.
Okay, so let's go ahead. So you mentioned in that discussion an escrow provision, and as we know, there are certain mortgages that are non-escrowing mortgages where a borrower pays their own taxes and insurance directly, and mortgages with escrowing provisions, because the lender in those scenarios thinks that from an underwriting perspective that it has greater risk with this particular borrower, so they want to ensure that those payments to insurance companies and the taxing authorities are made directly by the lender. So talk to us, though, a little bit about what that provision looks like.
Sure, and it's not always that a borrower is a greater risk. There are certain loan programs that require for that loan product that there be an escrowing provision in there. But in general, what it means is for every monthly payment, there's going to be a portion of that payment that is usually for taxes and insurance. The lender then banks that money, and at the time that taxes and insurance become due and owing, they actually tender the payment on behalf of the borrower. Now, if the borrower has a non-escrowing mortgage, then the lender typically requires proof that insurance is being maintained on the property and that the taxes are in fact being paid. And if those things aren't taken care of, then the lender will step in and what we call forced place insurance or pay the taxes where they're not otherwise being paid.
So let's break down this concept of forced placed insurance. When a lender on its own imposes or pays for insurance for the benefit of the borrower, but not through the escrow, what happens in that scenario?
So if a lender begins to have some concern that the property is not being properly insured, and this is important because it's another protection of the lender's interest, right? If the house burns down, then the lender's security, and it's not insured, then the lender's security interest is upended. They've lost essentially the value of the security that was supposed to be there in case the borrower defaulted and the loan needed to be repaid through foreclosure. But if a lender believes that there is no insurance being paid, there's a number of steps they have to go through in terms of contacting the borrower, asking for proof of insurance, and once they've run that gauntlet and followed all those rules to verify whether or not there's insurance on the property, if it's not there, they'll actually purchase a policy of insurance as the lender and have the property insured. It's called forced-placed insurance. And typically the premiums, which are then billed to the consumer, are much higher than the policy that the consumer would have obtained because there's already risk at play by virtue of the fact that the consumer has failed to purchase insurance.
So you've mentioned now among various provisions, insurance, escrow provisions, requirements that a mortgagor not allow a lien to attain super priority. And you touched upon another provision in the mortgage, again, that protects the mortgagee to make sure if they have to foreclose that they will hopefully be able to recoup their entire debt. And that was a due on sale clause. Can you break down a little bit more about what is a due on sale clause?
Sure. Essentially, what happens is if a homeowner whose property is subject to a mortgage. In other words, they've borrowed the money to purchase the property, and the property secures the loan. If they try to transfer title, if they try to transfer the property to somebody else, so imagine a really bad actor. Homeowner decides to take cash for the property and sell it to some other person without telling the lender. As soon as they transfer title to the property, under the terms of the mortgage, the entire amount of the mortgage becomes due. So the mortgage debt accelerates, to use the official term, and it's considered a breach of the mortgage, and the entire amount becomes due. Because obviously we can't have the owner of the property who took out the loan giving the property to somebody else.
So just to make sure I understand, so if I obtained a mortgage and decided to sell my house to somebody in another country that I never met and that my mortgage company never met, that would trigger an immediate acceleration of all the money due under that note and mortgage and provide for it to be foreclosed.
That's exactly right. That's exactly right. Now, there are exceptions to this due on sale clause that have been created largely by statute. The Garn-St. Germain Act is a federal statute. Most states have their own versions of those. And this is designed to protect transfers that we as a society have decided need protection and should be allowed to be made because they're not really going to disrupt the lender's interest in the property. Most common is conveyance upon an individual's death. So if a husband and wife are living on a property, the husband passes and say the husband was the only person on the note and on the mortgage, it can convey to the wife. And that's not going to be a violation of the due on sale clause because the Garn-St. Germain Act says it's not going to be a violation of the due on sale clause. So generally, these kinds of post-death transfers that are in the ordinary course of administering an estate, those are not going to be violative of the due on sale clause. But anything else that would transfer the title of the property to some other party and make it very difficult for the lender to enforce the mortgage and liquidate the security will be.
So, thank you, Brian. And so, last but not least, one of the things that you often hear about, so if in the context of mortgage payments, because we've talked about a payment including money paid to the mortgagee or servicer typically for principal, interest, taxes, and insurance in an escrowing loan. If a payment includes all of these as part of the normal monthly payment, what happens if the borrower short pays, doesn't pay the full amount due in a given month?
Sure, it's a great question. So if all of these things are supposed to be paid out of a given monthly payment, how does the lender decide what to pay if the borrower pays less than the full amount? It's actually laid out in the loan documents. There's something called a payment waterfall, and it specifically provides, okay, and it's not the same in every case, by the way, but it specifically provides first we're going to pay X, then we're going to pay Y, and usually, well, if for example, the home has mortgage insurance on it, oftentimes in many programs, that will be paid first. Then interest or principal, depending on the loan, taxes and insurance. And so those amounts get paid in whatever order the documents specify. And then to the extent that there's a deficit or an amount that is not paid, that gets booked, if you will, and the lender can then either use escrow funds or advance funds to make up the difference if needed in order to protect their interest in the property.
Thank you, Brian. And thank you for attending our episode today. Please look forward to future Maddin Hauser mortgage industry episodes.